Okay, we're going to look at some more taxable versus non-taxable exchanges, only this time we're going to compare some different rules with different values. So we're going to have boot involved. Okay, so we're looking at Firm A exchange an old asset with a $20,000 tax basis for a new asset with a $32,000 fair market value. Under each of the following assumptions, apply the generic rules to compute A's realized gain, recognized gain, and tax basis in the new asset. So our first one is our old asset and new asset are not qualified property for non-taxable exchange program. So at this case, then our cost is, our fair market value is $32,000. Our tax basis was 20. Should put that as a minus. Okay, and means I have a realized gain of 12,000 because it's in a taxable. It does not qualify as a non-taxable exchange. Our recognized gain is also going to be 12,000, and because of that, I've recognized my gain. My new basis in the new asset is going to be the fair market value of that asset, or $32,000. In Part B, our old asset and the new assets are qualified property for non-taxable exchange purposes. Okay, so we're going to have here our same gain. Oops. So we're going to have a gain of $12,000 that's realized because it's a non-taxable exchange. We have zero recognized gain, and therefore my tax basis then is going to be $20,000, which is our old tax basis. Okay, in Part C then, we have our old asset and new assets are not qualified property for non-taxable exchange purposes. To equalize the values, Firm A had to pay $1,700 of cash or boot to the other party. So the amount realized for the sale then obviously must not have had a value of the old value asset must have been only $30,300 because we had to pay an additional $1,700 to get up to the amount realized for the sale of $30,300. So okay, so my amount realized for the sale is going to be the $32,000 fair market value minus that $1,700 boot that we paid. So $30,300 is what our actual sales price is. My tax basis, again, didn't change. It's still $20,000. My realized gain is $10,300 because it's in a taxable exchange. My recognized gain is $10,300. And again, my tax basis, because I recognize the gain, my tax basis in the new piece of equipment is actually going to be the fair market value of that equipment, or $32,000. So even though my recognized gain and realized gain changed, my tax basis in the new equipment did not change because it's taxable exchange, and the new equipment basis is always going to be the fair market value. Okay, so Part D then is the old asset and new asset are qualified property for non-taxable exchange purposes. To equalize the values exchanged, Firm A paid $1,700 cash to the other party. So the same as in C, only a little bit different. So my amount realized for the same is going to be calculated the same way. It's going to be my $32,000 fair market value minus the $1,700 boot that I had to pay. My tax basis was the same, $20,000. Okay, so my realized gain is $10,300 because it's a tax deferred. It's qualified as a non-taxable exchange. My recognized gain is zero. My tax basis in my new equipment is going to be my original $20,000 plus the $1,700 a boot that I had to pay. So my new tax basis in that new asset is going to be $21,700. So we deferred some of that gain. Okay, so now let's look at E. The old asset and new asset are not qualified property for non-taxable exchange purposes. To equalize the value exchange for a received $4,500 cash from the old party, from the other party. So that means my asset is actually worth more. So it's actually worth the $32,000 fair market value plus the amount of boot of $4,500. So that means the amount realized from the sale is actually $36,500 fair market value of the asset. So the fair market value of the asset of $32,000 plus the cash is $4,500. Okay, my old tax basis was the same, so it's $20,000, which means I have a realized gain of $16,500. Because this is a taxable exchange, I have a recognized gain of $16,500. And my tax basis in the new equipment is going to be $32,000, which is the fair market, which is going to be the fair market value of that equipment. Okay, and finally we're going to look at Part F. The old asset and the new asset are qualified property for non-taxable exchange purposes. To equalize the value of this exchange, firm A received $4,500 of cash from the other party. So our basis is going to be calculated, or the amount from sale is going to be calculated the same, $32,000 plus $4,500. Oops. Plus $4,500 of cash boot. My tax basis is $20,000. My realized gain is $16,500. Now my recognized gain is, we got to remember the rules on this, is that a cash boot on a non-taxable exchange does trigger recognizable gains for that amount of cash. So that $4,500 is going to be recognized as a gain. Okay, and then my tax basis on the new asset, that new equipment, is going to be $20,000. So my basis carries over the $20,000. Okay, the recognized gain part of that $4,500 is going to be, that has to be recognized because of it was a cash exchange on that part. So the cash part, we have to recognize that gain when the cash exchange hands like that. So that's how we handle different items for taxable versus non-taxable exchanges where boot is involved.